Good morning, Jags. This is Fahad. Today is Tuesday, March 9th. Let's get started. There's an interesting article out, and it was posted by Business Insider. It's a research piece, summary of a research piece from Deutsche Bank, in which they did some analysis to came back with a thought that of this $1.9 trillion stimulus that was just passed last week, actually this week, and it's going to be signed by President Biden in the next coming days, and the checks will start to go out to Americans within a couple of weeks after that. Deutsche Bank believes that as much as about 170 billion of that $1.9 trillion will eventually find its way in the stock market. And most of it is going to be from people in the age group of 25 to 34-year-old, which continue to, then this is exactly what we saw at various times when different kind of checks and stimulus were given out in 2020 as well, that this age group, 25 to 34-year-old, are planning to invest pretty much all or at least half of their checks that they will be getting in the stock market. Last year, we saw that as much as 40 to 50% of their stimulus checks at various times found its way into hot stocks. So this is interesting note, right? And these checks will start to come out within the next couple of weeks. So I started to do some digging to see if that's going to happen. Where are the millennials, this age group 25 to 34, where are they investing? And the answer should be really obvious, but I'll show you some clips. Here is an article that comes from TrueCar Advisor, and they talk about which generation is buying the most electric vehicles. They found out that Generation X are buying 39.8% of all the vehicles that, almost 40% of the vehicles that Generation X are buying are actually electric vehicles, followed by closely by millennials, with almost 35%. This is pretty strong, and people tend to invest in the same areas, generally speaking, when they put their money in the stock market that they tend to like and they tend to buy for themselves product wise. Here's another article that came from NetBase Quid, in which they said exactly the same thing. This article is more than a year ago, but I would imagine that this has taken even a new leg higher since then. It's more than a year-old article. Young investors increasingly attracted to the electric vehicle conversation. And you probably see this in your own family too when you talk. And not only they are just buying these vehicles, they are also investing in the stocks that produce these vehicles. Now, with all of this background, here's an interesting news that came out this morning, and this is about Fisker Automotive. Fisker Automotive is announcing this morning that it has reached now 14,000 reservations. It has passed 14,000 reservations for its Fisker Ocean SUV. Fisker Ocean SUV. And this is an SUV that continues to see boost by interest and orders from the fleet market globally. In Q4 of last year, the company signs its first significant fleet order for 300 vehicles with Vigo, the technology-driven Danish ride-hailing service. And so in just less than 3 months, they've gone from having their first order of 300 vehicles to now having over 14,000 reservations on hand. Now, I discussed Fisker, symbol FSR, in the chat room 2 weeks ago. I want to show you a couple pictures of what this car looks like. So here is first picture. This is what this SUV looks like. This is the front. Then this is the second one. This is what the indoor looks like. Pretty sweet, right? And then this is the what the back end looks like. So, a pretty interesting car. But here's something about Fisker that many people probably do not know. Fisker is not going to be taking fully in charge of all the auto production and the manufacturing that comes along with it. They have adopted rather a very lean operation methodology in which they are depending on a company called Magna International, MGA, a European-based company which already produces on fully outsourced contract basis full high luxury models for Mercedes and BMW. You may not know this, but a lot of the production for the high-end models for Mercedes and BMWs are not produced by actually those OEMs. They outsource everything, not just the parts, but actual entire manufacturing to the assembly lines that are owned by Magna International. And that's why I've always, of all the auto parts makers, I've always favored Magna over others. This is a very high margin business for all of them, and so they produce full cars, but they're sold under the name of Mercedes and BMW. You can read all about this in prior research notes that in Jag that we have produced. Anyways, so this creates a lower capital intensity and an easy access to the market, an easy launch without having to run into production problems. And that's exactly what Fisker Automotive has done. They're outsourcing their entire production of this SUV called Ocean SUV, or Fisker Ocean, that is expected to be released sometime in 2022 to Magna International. And what this is doing is this is creating a deceptively low execution risk on part of Fisker Automotive. Now you consider this and you will find out that Fisker Automotive market capitalization right now is only what, $6.5 to $7 billion. And the real question is this thing compared to, let's say, where Tesla is today with over $500 billion in market capitalization. And I understand there's no apple to apple comparison given the moat, given the charging station infrastructure that Tesla has already installed, given over the air upgrade system that's already in play, and everything else that Tesla is doing. There's absolutely no comparison, but still, $7 billion versus $500 billion, or $7 billion versus even the traditional OEMs such as GM at 65 some billion dollars, or others. The question here is that is the millennial money that is coming is going to once again find itself into these hot sectors such as electric vehicles that going to drive the future technologies in the automotive sector. If that happens, Fisker is going to be one of them. And this news out that in just 3 months they've gone from 0 reservations to 14,000 is basically telling us that the adoption curve will be strong. What if they get to 50,000 or 100,000 total reservations by the end of the year? So something to keep in mind. Now, let's watch how this stock reacts today. And let's see if this news is going to cause a bit more recovery in the name after this thing has been decimated from high of 28, 29 to currently trading at $21 per share. On the high level, I would also like to mention that the similar kind of millennial money could also find itself into some of these Chinese EV makers that have been decimated. So for example, NIO. NIO was at $60 per share, and here we are trading at $35 per share. $60 to $35 per share. NIO posted, just quickly looking at their earnings report over here, NIO posted 130% growth in the fourth quarter in its total vehicle sales. Keep in mind, this is a company that used to do only 2,000 to 3,000 unit sales per quarter. And now it is regularly guiding almost 20,000 unit sales per quarter. And that's just in the matter of 4-quarter improvement from 2,000 to 3,000 per quarter to now 20,000. LI, this is another Chinese automaker that has been decimated from 35 to 21. You take a look at this company's last earnings report. They posted 64% growth in vehicle sales. And then XPEV, XPEV, the stock decimated, cut in half in just 3 weeks from 50 to 26. And last night, this company posted over 300% year over year vehicle sales in China. To go along with all of this, I would also like to quickly show this article, which is what could potentially be the catalyst, in a sense, that could charge these Chinese automakers to come back to life and the momentum to start again. And that catalyst could be, and this news also came out this morning, that all 3 of these Chinese automakers that I just named are eyeing Hong Kong listing this year to raise combined $5 billion in cash. And there's a Reuters article about this. The trio, which is NIO, LI, and XPEV. All three companies, the trio, each aim to sell at least 5% of enlarged share capital in Asian hub. The people said based on the New York market capitalization on Monday, proceeds could reach $5 billion. The last time this happened, for example, to Baidu, this stock went in on a massive run with a breakout all the way to the upside. Same thing happened previously in NetEase, which also listed its shares in Hong Kong and raised capital, and that stock had a monumental run. So the point here is that if you're looking for a specific catalyst aside from just the organic growth, watch all of these automakers could be listing soon in China. That's it from me. Let's go to Jay.
Morning, everyone. Today looking at Zoetis, ticker ZTS, and specifically their upcoming drugs within their pain portfolio. And I'll preface by saying that these drugs have not yet been approved in the United States. Approval is likely, but we are still several quarters away from that happening. Anyway, the two drugs, number one called Librela. This is the first injectable antibody therapy that's approved right now in the European Union for monthly alleviation of osteoarthritis in dogs. And back in November, the company received European Commission marketing authorization. The second drug, which is called Solensia, also last month on February 22nd, the company announced that the EU granted market authorization for this drug, and this is their CAT osteoarthritis treatment to alleviate pain. Stifel analyst Jonathan Block was out with a note last night where he surveyed 82 vets in the United States and provided a brief description of these drug offerings, and then asked the vets their likelihood to adopt and the impact that that these would have on their practice. Well, 96% and 93% of the vets expect to adopt both Librela and Solensia respectively, and this is well ahead of FDA approval. And in terms of revenue opportunity for Librela, Stifel said that the vets reported that they see on average 338 dogs with chronic OA pain, and that 82% of these dogs are treated with a pharmaceutical. So market share gains within this subset represents a significant revenue opportunity. Additionally, the 18% of dogs that these vets are not treating with a pharmaceutical arguably represents an additional opportunity, as do a subset of dogs that are currently undiagnosed. So with the current global canine OA pain market totaling 400 million, if roughly 40% were to switch to Librela, they see a first 24-month opportunity of $150 million or more. And then finally turning to Solensia, Stifel says that if 2 million cats were on Solensia at a $100 per annum cost to the practice, this equates to an annual 200 million US opportunity. So like I said, we are still several quarters away from FDA approval here in the US, but early feedback is certainly promising.
Very interesting. This reminds me of Simparica, that company launched, which did quite well despite the pandemic hiccups.
Yeah, and in that note, Jonathan Block talked about how back in Q3 of 2019, he basically did the exact same survey, and actually based on his feedback from this time around, Librela and Solensia seems to be tracking even higher than the trio.
Wow, so it's doing even better than Simparica. And Simparica
Early
was a
feedback,
yeah, and Simparica launch is so significant that it was the first launch for I'm trying to forget that name, the category for the animal healthcare's particular category, for flea tick, I think it was, and and there had not been a new product in that particular category from anyone in the industry for more than 5 years, and then Simparica came along and started taking market share from everybody. and we discussed this a couple different times at that time in 2019 and 2020 regarding ZTS. Now they have these two new products also coming up that should also provide the upside. Great stuff. Stock has pulled back, let it form a base, and I think this will too present yet another buying opportunity on this downtick. All right, let's go to Chronicle.
Morning. Today I'm looking at News Corp New, ticker NWS, which probably needs no introduction. This is the news umbrella that runs the Wall Street Journal, Market Watch, Barron's, New York Post, and then outside the US, the company also runs UK Times and The Australian. And everyone's probably heard of Rupert Murdoch. So I don't have a position in this stock, but it's been on my watch list for 3 reasons. The first reason is, of course, the anticipated recovery of both digital and physical advertising spend, not just in the US, but also in Australia and the UK, which we detailed recently with Clear Channel Outdoor. So overall, worldwide advertising revenue is expected to rise 10.2% in 2021, after a 4% decline last year. I think it's in the next image. That's according to Group M, which is part of WPP. And then meanwhile, Zenith Group, which is under Publicis, estimates that US total ad spending will grow 3.2% this year. Logically, this should be a tailwind for News Corp's advertising revenue, which typically represents between 40 to 50% of their total news and digital real estate revenue. So that's the first part of the bull case, which is pretty straightforward. Second part is this 3-year partnership that the company signed with Google on February 17th. Which came as a result of Google's recent dispute with the Australian government regarding the compensation of local news publishers. So basically, to appease the Australian government, Google is going to start paying News Corp in the form of recurring ad revenue sharing in exchange for being able to share content from the Wall Street Journal, Market Watch, Sky News, and so on. And this was something Murdoch had been fighting for almost a decade, because News Corp runs more than 2/3 of Australia's news industry, believe it or not. And now, after all these years, he's finally got what he wanted. So the most immediate tailwind here is that this is going to add to News Corp's recurring revenue. But I think the other hidden tailwind here is that we may start to see other countries forcing big tech companies to share their ad revenue. I think there's a good chance we may see similar policies being enacted in Europe, especially, and then reportedly the US DOJ is also looking into the matter. Essentially, there's this growing view among developed nation governments that these big tech companies like Google, Facebook, and so on, they cannot be hoarding all of the money. So I guess the main point here is I like the optionality going forward, because if the US and European countries start bringing more of these policies into fruition with other companies, not just Google, then it implies higher revenue and margins for a content publisher like News Corp. So this is bull case number 2. And then number 3, my last point here is that this is also kind of a special situation play, because Rupert Murdoch is about to turn 90 years old. And reportedly, he's been looking to do one last major deal for the company before he, effectively relinquishes some of his control. And something that I noticed yesterday was that Rupert Murdoch bought about $12 million worth of NWS shares, which is very unusual for him. So right now, there's been growing rumors that Murdoch could be looking to reunify or recombine some parts of Fox Corporation with News Corp. And apparently he's been doing a lot of consulting with his eldest son, Lachlan Murdoch, who happens to be the current CEO of Fox. So I think there could be something in the works here, and this is yet another optionality.
Very interesting, especially about this special situation case over here. There's going to be some sort of consolidation coming in the space. March 5th is when he bought these $12 million worth of stock in the open market of NWS. Interesting. I like that. I think they already have pretty significant share in a lot of these properties that they own, such as Wall Street Journal, which was previously sold by Dow Jones or the family for $5 billion long time ago. So there are definitely synergies over here that can be derived from further consolidation and bringing all it under one umbrella, especially on the news side. So something to watch. Good stuff. Something I'm going to be keeping an eye on this, because if there's something brewing over here, we should also start to see some sort of pickup in call option activity, particularly in the leap call options. This space has gone through several layers of consolidation in the past, and I wouldn't be surprised if there's more coming. All right, folks, I'm going to quickly discuss something here real quick, which popped up before closing out, which is Surface Oncology, SURF. You see, this is a great example of how things get decimated for all the wrong reason, and then suddenly you realize, oh my gosh, why did it come down as much? There was no reason. Now, many clients know that when this stock was trading around $9 a share, that's when I presented a bull case, and out of the box bull case for this stock, we recommended buying call options, not call options, buying common. This was on November 30th, right over here. On November 30th, we recommended buying Surf Oncology common stock for $8.70. And the stock had such a rapid rise that on January 25th, almost perfectly near the highs of the year, we closed that entire position for 51% gain, closing common for 51% gain. And since then, I have not taken a position in this stock yet. I bring this up because they just moments ago reported earnings, and it is fantastic. And by the way, on this way down, while the stock has continued to pull back, I've fielded a lot of client questions that have been asking me whether it's time to get back in. Let's get back in. But I have avoided this name because I wait for the technical turnaround picture before stepping in. This thing is going to spike hard sharply in pre-market. It's up almost 15 to 20%. Cathie Wood has been buying this stock on the way down as she sees the same opportunity in this small cap that I see. And now she's going to start to get paid on this one. I bring this up because this has market capitalization of only $299 million. And this company moments ago reported revenues of 87.6 million. That's for the fourth quarter, 87.6 million versus expectations of only 42 million. That's more than 100% beat against consensus. 87.6 million versus 42 million. To give you another perspective, for the 9 months ending through September 2020, so we're talking all 9 months combined, that's 3 quarters, company's total revenues was $38 million. And then the consensus for just the fourth quarter was 42 million, and the company posted 87.6 million. I have not seen the guidance on this one yet, but I would imagine that they're going to continue to grow this all the way up until 2023 based on my previous work. So tell me again, why does this stock, which is 87 million revenues in a single quarter, market capitalization of less than 300 million, why is this so cheap? It should not be so cheap. And if it were to go up to a multiple level versus peers at 4 to 5 times sales, this is a multi-bagger from here. This should really trade at $25, $30, $40 per share. Will it get there eventually? I surely think that it can get there, and they have a lot of other things on the product pipeline as well. So just wanted to briefly discuss this. Watch this stock carefully. I think it's going to be a very, very strong name today and for the next couple of days. That's it from me. I'll see you in the chat room shortly.